If you buy one stock, your money depends on one company. If that company has a bad earnings report, a failed product, a lawsuit, or a new competitor, your investment can drop fast. That's the risk of putting all your eggs in one basket. ETFs and mutual funds solve that problem with an actual basket of investments. An ETF, or exchange-traded fund, is a fund that holds many stocks at once. You buy one share, but inside that share could be tiny pieces of hundreds of companies. For example, an S&P 500 ETF can include Apple, Microsoft, Amazon, Costco, and hundreds more. One purchase instantly spreads your money across a huge basket. Mutual funds work very similarly. They also pool money from many investors and buy a basket of stocks or other investments. The biggest beginner difference is how they trade. ETFs trade during the day like stocks. Mutual funds are priced once after the market closes. But for beginners, the important point is that both give diversification, which means spreading your money across many investments instead of relying on one company. Here's why that matters. Imagine you invest $1,000 into a single stock and that company drops 50%. You now have $500. But if you put that same $1,000 into a fund holding 500 companies, one company crashing has a much smaller effect. That's the basket working. Diversified funds also make investing simpler. You do not need to constantly research one company or panic over every headline. You're betting more on the overall economy than on one company's future. One caution: not every fund is automatically safe. Some only hold one sector or a small number of stocks. For beginners, broad market funds are usually the simplest option. ETFs and mutual funds are basically baskets of stocks, and that basket is usually safer than betting everything on one company.